Next week is the start of something different. The first Fed cutting cycle since 2020, and really 2019 if you want to minus out the COVID crisis that was 2020. This has big implications for markets. And as Seth Golden on X puts it, fun fact, every trader in every city of every nation around the world right now is wondering, quote, if the rate cut will be a sell the news event. If you guys have not already followed my X account, it's Michael Tyler over there. I did do a poll and asked you guys, what is the Fed going to do? 25, 50 basis point cuts, or are we just effed either way? Here in this video, I will give you a breakdown of what you need to know, what history suggests, and what could be coming next for markets, depending on if Powell does a 25 or 50 basis point cut. And I have to tell you, betting markets are confused. So there's a 44% chance of a 50 basis point cut. There's a 25 basis point cut that's priced at 56%. So you are neck and neck between a larger rate cut and a normal 25 basis point cut. Now, here's a fun fact. For the last 50 years, the Fed always goes with what the markets are pricing in. That's why they use communication and forward guidance. They don't like to surprise the markets. The last thing you want to do is surprise the markets with a big rate cut when we were not expecting it, and freak everyone out and cause a stock market crash and cause a recession. And after all, household exposure to equities is at a historic high right now. Freaking out the markets could actually be the catalyst to give us a recession, because what are companies going to do? They're going to say, oh crap, our stock's crashing. We need to boost estimates. We should probably lay off some employees. With that said, let me give you a little bit of context around 25 basis points or 50 basis points. Because yesterday, the markets were only pricing in a 14% chance of a 50 basis point cut. That has jumped all the way to 44% today. Basically a coin toss, whether we get 50 or 25 basis points. And there's really three reasons for this. Let's start with Nick Timmerhouse. Jim Bianco writes on X, actually, this is different. Before the June 15, 2002 and March 22nd, 2023 FOMC meetings, the odds of a Fed move were very uncertain, around 50-50. But Nick Timmerhouse stories right before these meetings removed uncertainty. So basically, the Fed has always used Nick Timmerhouse to guide the markets in a certain direction, okay? This time, Nick Timmerhouse's story kind of guided the markets to a 50 basis point cut overnight. Jim Bianco's post goes on to say, Nick Timmerhouse's stories right before these meetings removed uncertainty, but yesterday's story created uncertainty. This post says, going into the June 15, 2022 FOMC meeting, things were uncertain with 35 to 45% odds of a 75 basis point hike. Nick Timmerhouse cleared it up with this. June 13, 2022, 48 hours before the meeting. His article titled, Fed likely to consider 75 basis point rate rise this week. You can see here, the odds jumped from 35% to 92% following Nick Timmerhouse's story. March 7th, 2023. Silicon Valley Bank fell. The odds were 100% of a 25 basis point hike before March 7th. They fell to 55% a week before the March 22nd FOMC meeting. Timmerhouse cleared it up on March 20th, sending the odds back to 86%, with this article that's titled, Federal Reserve Faces Tough Decision on Rate Increase. And you can see here, Nick Timmerhouse's story came out, and the odds skyrocketed again. Now, to repeat the chart above, the odds of a 50 basis point hike before Timmerhouse's story were 14%. Now, it was settled. They were going to do 25 basis points. Today's story took this certainty and made it uncertain, with Nick Timmerhouse's article titled The Fed's Rate Cut Dilemma. Start big or small. You could see Nick Timmerhouse's story that came out, and boom. Now you're technically at about 47.5% odds of a 50 basis point cut. Like, as soon as the story came out, markets reacted. And this was following the CPI report that just came out as well this week that really pushed those odds from 39.2% of a 50 basis point cut down to 14%. And we were sitting at about 14%. And then the story came out from Nick Timmerhouse, and you're at one point, we're pricing a 49.2% chance of a 50 basis point rate cut. Jim Bianco goes on to say, unless we get more stories to clarify things, I cannot find another meeting going back to the 1990s that was about 50-50 a few days before a meeting. This is due to the Fed's bedrock principle of forward guidance. Forward guidance means telling them what you'll do before you do it. Now we have maximum uncertainty. Did Timmerhouse's story wreck forward guidance? Was this the plan or an unintended consequence? Gold, which thrives on uncertainty, especially monetary policy uncertainty, is now up more than 2% since the story was posted on the Wall Street Journal website last night. So for a little bit of background for anyone that is not familiar with Nick Timmerhouse, he's the correspondent, the chief economic correspondent over at the Wall Street Journal, and he is seen as the Fed's mouthpiece. He's also known as Nicky Leaks because he tends to guide markets in one direction or the other, and the markets were not pricing in a 50 basis point cut just yesterday. But after Nick Timmerhouse's story came out, markets are pricing in what could be a 50 basis point rate cut with roughly a 50% chance. That's not where the Fed wants to be heading into the Fed meeting. The Fed does not want to be a coin flip between one policy decision or another. That can surprise markets, and that's not how Jerome Powell likes to operate. So this is the first thing that moved betting markets quite a bit today. Next up, former Fed New York President Bill Dudley expressed support for a 50 basis point interest rate cut, Reuters reported on Friday. He said, quote, I think there's a strong case for 50, whether they're going to do it or not. He points out that the current rates are about 150 to 200 basis points above the neutral rate, which is 1.5% to 2% above neutral, where policy is neither restrictive nor accommodative. Previously, Dudley had advocated for rate cuts beginning in July. So this is another one of those influential voices that the Fed pays attention to. In fact, on the last press conference, there was actually a question posed to Jerome Powell if he's seen the report about Bill Dudley suggesting the Fed should cut rates. And that's what led into the conversation of Jerome Powell saying there was a discussion about cutting rates at the last Fed meeting. Remember that? Powell said they obviously didn't decide to do that, but there was a live discussion about cutting rates at the last Fed meeting. Part of that had to do with, I would imagine, what Bill Dudley was saying the Fed should do. I mean, that's what sparked that whole conversation from Jerome Powell on the podium last Fed conference. And the third thing that is moving the odds of a 50 basis point rate cut higher is Claudia S, the famed economist that literally created the SOM rule. She says, quote, the Fed needs to start getting out of the way and deliver a big rate cut next week. Economist Claudia S urged the Federal Reserve to cut interest rates by 50 basis points next week. S cites solid inflation progress and a slowing labor market as reasons for the big rate cut. S also reiterated that the U.S. economy is not in a recession despite her namesake recession indicator flashing. S told CNBC on Friday that the inflation data alone is enough to cement a jumbo rate cut from the Fed, not to mention recent signs of a slowing labor market. The Federal Reserve absolutely needs to deliver a 50 basis point interest rate cut next week. She says, quote, you got 2 more months of good inflation data. That's what the Fed asked for. That on its own would have gotten us 25 next week, as it should, and will get us a whole string of cuts after that. He says there's an aspect of just recalibrating. We got some more information. We need to kind of clean it up, do a 50 basis point cut, and then be ready to do more. Now, here's the problem with the 50 basis point cut and how the markets historically have taken that. Now, once you start the cutting cycle, it doesn't matter what the Fed, what pace they cut at. If they want to do a couple 50s in there, that doesn't matter. What the Fed starts with historically kind of dictates how the markets perform. Okay, I've showed you guys this in prior videos, so I'm not going to sit on it for too long. But this is going back to 1995 and the first Fed cut in a cutting cycle. Okay, so in 2019, the Fed cut 25 basis points. 2 years later, markets were up 54.1%. In 1998, the Fed started with a 25 basis point cut. Markets were up 41% 2 years later. In 1995, the Fed started with a 25 basis point cut, and the markets were up 73% 2 years later. In 2001, the Fed started with a 50 basis point cut. Markets were down almost 31% 2 years later. In 2007, the Fed started with a 50 basis point cut, and the markets were down 26.3% 2 years later. So I think just from this historical precedence, if the Fed does do 50 basis points, you have a lot higher of odds that the markets actually sell the news on that event next week. Like dramatically higher odds that we have some kind of correction or ultimate crash. And the reasoning for that, one, historical precedence would say a 50 basis point cut for the first cut is not good. But also, it really just suggests the Fed is behind the curve, that there could be too much damage done to the economy for the Fed to really stop it. Whereas a 25 basis point cut shows more confidence from the Fed that they did not do too much damage and things are not too far gone. Going to be very interesting about this upcoming Fed meeting next Wednesday is we only have one piece of data that is going to move the odds of a 50 basis point cut or 25 basis point cut that will solidify the chance of this, okay? And that is retail sales. If retail sales come in bad, then you're going to get a 50 basis point cut. The markets are going to price that in, and that's what the Fed is going to do. Unless we get a story from Nick Timmerhouse over this weekend or on Monday that sways these odds, which is definitely possible, it's all going to come down to retail sales. Now, the problem here is retail sales came in at 1% last month. So when you're looking at month over month numbers, you have to see some impressive numbers to be positive here, right? Because, you know, if you're up 1% last month, if you're not at least up 1% the next month, you're going to be negative. Okay, because you're looking at a month over month comparison. So we're expecting 0.2% positive. So that's actually really strong. If we're looking at last month, that was 1% positive. If we come in, let's say negative, that's a problem. Markets are not going to like that. That's going to raise recession risks. And that's going to solidify a 50 basis point cut, which the markets may sell that event. I also want to just kind of explain. It feels like we've kind of seen a blow off top last couple of days of a rally. Okay, we've rallied in just the last couple of days about 4.5% from the lows in just 3 days, just this last week, right before the Fed is set to cut rates the first time. That feels like a blow off top rally to me. That feels like one of those rallies to shake out the bears, to shake out the shorts, so people are not prepared for the downside move. Because again, if you're a gambler, you understand this correctly, or if you've just been in the markets for a while, if everyone's bearish, you're probably not going to get a sell-off, right? You're probably if everyone's positioned for a sell-off, you're probably not going to get a sell-off. If everyone's super bullish, that's precisely when you tend to get that sell-off. I think this latest couple of day rally is getting people bullish, could be preparing market makers for what could be a down move coming next week. Now, there's other factors that go into this. We're going to get a new dot plot from the Fed. If the Fed signals higher unemployment, if the Fed signals lower GDP, that's also going to be problematic. That could be the Fed basically saying, we're going to head close to a recession. So I think the Fed's dot plot will also be an important aspect of next week. We do still have the 2- and 10-year yield curve inversion that has been uninverted now for about a week, which historically is when you want to be defensive in markets. Historically, this is when you want to, reduce your exposure, kind of, get ready for a recession if we do see one, because every time you've went inverted on the yield curve, you have eventually went into a recession. Every time. When you actually uninvert, that's when you tend to be like 3 to 6 months away from an actual recession. Okay, so you've done that now. Now you're uninverted. You could be just months away from a recession. And that's what Wall Street is trying to figure out right now. And that's why retail sales will be so important. And that's why the Fed's dot plot will be so important. Because if the Fed signals that, hey, maybe we are heading into what could be a recession, and that's why they do 50 basis points, that's not going to be seen as positive by the markets. So I do want to point this out as well. Because besides just the Rona, that was really an event that came out of nowhere that forced the Fed, the government, to take aggressive action to minimize the chances of a depression. The last real cutting cycle you had from the Fed was 2019. The Fed cut rates on August 1st, on September 19th, and on October 31st. 25 basis points apiece. Now, I want you to pay attention to the first Fed cut, because if we're thinking about what could be a, sell the news event, you want to look at the first cut. Now, the first cut was August 1st. What happened on August 1st? Market S&P sold off 1%, sold off another 1%, and then sold off 3%. So the following 3 days after the first cut, markets fell like 5.5%. End up getting about a 7% top to bottom correction just within about a week after the Fed cut rates. And I think 2019 is very similar to where we are today, believe it or not. If you were invested in the markets during 2019, then I think you can relate to this. But back in 2019, there's so many similarities, it's actually stupid. The yield curve went inverted, right? Look, in August, the yield curve barely went inverted, like barely. 4 basis points. August 27th, right after the Fed had cut rates, and then we went positive again. And everyone during this time was like, oh yeah, we're going into a recession, or at least there was more of the recession argument, right? Kind of like today. Some people were in the Fed's just cutting because they can, right? That we're a little bit too restrictive. And there was the argument as well that, yeah, sure, the Fed's cutting. The yield curve went negative. Now it's positive. We need to be on recession watch. Now, in 2019, nobody really forecasted by March we would be in a recession. You would have the COVID crisis. But during that time, yield curve was inverted, went positive. That just happened as well for us today. The Fed started cutting rates with 25 basis points. That's kind of the difference, 25 basis points versus what could be 50 basis points this time. And you still got to, sell the news, right? In 2019. I think this time's probably going to be pretty similar to that. After all, I mean, there's a lot of similarities to today and 2019 as far as the economy is concerned and the consensus by Wall Street. Now, it is worth mentioning that after the rough seasonal, September that we had, September, October in markets, where you actually did dip another 5% or so in October, you had a very aggressive end of the year rally where really from that, August high, you ended up going up about 13.5% from that, pre first cut 2019 S&P level to the high of the year. If you had bought the dip like I did back after the first Fed cut in August, you were actually up almost 22% by the end of the year. And then obviously you had the Rona that came in, and the rest is history. But this is kind of the forgotten history of before the pandemic. So from that perspective, it's probably likely that we do get a sell the news event coming next week. But then again, it really depends how the Fed frames this. If the Fed is sounding super dovish, like they're not concerned about the economy, that we're going to be just fine, there's no recession risk, then markets don't have to sell off. That was kind of like 2019. The Fed was not screaming recession either when they, cut rates. they still cut rates, and you've still seen a, sell the news event. If the Fed does sound more cautious that the economy is weakening and maybe we do tip into a recession, maybe their GDP estimates come down quite a bit for next year, then Wall Street's going to look at that, what could be 50 basis point cut, and they probably won't like it. Now, on the other hand, you can also make the argument that if the Fed only cuts 25 basis points, that Wall Street's going to say the Fed is so behind the curve, they are going to push us into a recession. So I don't know what's better. 50 basis points may be better. It may give us a short-term, larger downside reaction in markets, but it may calm some of those recession fears a little bit more. If the Fed only does 25 basis points, maybe we get a less harsh initial downside move next week, but maybe it boosts some of those recession fears. So it's a tough call. I think cash is king right now. I think you want to be in areas that will do okay no matter what. A lot of stocks that are beaten down, a lot of interest rate sensitive stocks. Those areas can be attractive. High dividend payers are going to be very attractive as the Fed cuts rates and those money market fund yields start to fall. But I do think cash is king right now, and it would make sense to have a hedge or two on your portfolio heading into next week. Not financial advice, just my opinion. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.